If you want to be profitable in this industry, you need to understand the language of price. So in my previous video, I was able to explain to you in detail two candle rejection, one of the best strategies that you can use to make profit in the industry. So hello ICT trader, this is Ageless. Now let's continue with it. Now this time around I'll be showing you some samples of trades that you can use two candle rejections on. Now on a weekly time frame, this is a weekly word time frame. Now let's take a look at it. Now if you have a price leg, don't forget I also explained to you that a price leg is a leg, a price action that has what fair value gap on it. Go and watch my previous video, you will gain some understanding or about what fair value gap. Now this is a bullish what bullish market. So what will you do? Now you map out your fair value gap. The moment you map out your fair value gap, then you wait for price to come into the fair value gap, because I've also explained to you that fair value gap does two things. It is a magnet and what? It is a rocket. It magnetizes price towards itself. So when price comes into it, it pushes price away. Okay, so that's why we call it what? Magnet and what? And a rocket. Now let us map out our what? Fair value gap. Now look at it. This is a fair value gap now. On what? On this weekly time frame. And this two candle rejection trading system, you can use it to what? To swing trade. If you're a swing trader, you can use it to swing trade, because this is weekly. So use it to swing trade. Now that you've mapped out your fair value gap, then you wait for a candle to retrace into the fair value gap. Okay, that first candle that enters into the fair value gap, you watch it closely. So when you watch it closely, then you now wait to see or to note if it's going to be a rejection candle. Now this is the candle that enters into the fair value gap. Now can you see that it enters into the fair value gap on a full body? So when it goes into this fair value gap, now it got rejected. That's why it went up and it eventually formed this what? This week. Now this candle that enter, is it a rejection candle? Yes, it's actually a rejection candle, because I've actually explained to you what a bullish rejection candles are. Look at it. These are the samples. Now this candle now is looking like this, all right, or probably this or this. So therefore, so price is expected to expand upward. Price is expected to move upward. Now why is this candle rejected? Two things. One, it came into a fair value gap that usually reject price. Two, not just only that we have a fair value gap here. Now this fair value gap is also in alignment with what? With swing point. This is our whole lot zone, overlapping line of difference. You can see that. So that means we have double assurance that price is going to be rejected. And when you have an overlapping area is a strong magnet. Price usually come to respect such zone. And when price comes into such zone, then it will be what? Pushed away. So it will push price away. So that's why we have what? This rejection candle. So now that you've determined that it is a rejection candle, how do you now trade it? Then this is what you should do. This is what you should do. So you wait for this rejection candle to what? To close. The moment it closes, you enter immediately. You place a trade, a buy trade, because we are trading upward. Okay, you place a buy trade. Once you place a buy trade, then you place your stop loss below the wick of the rejection candle. Then you target the next swing point, the next PD array. You understand? You go to a higher time frame to see if there is a PD array above it, or probably your 1:2. Your 1:2 is more than enough to make you what? A lot of money from this trade. Okay, now let's see, just take a look at how it's eventually, or how it will play out. Okay, so you enter here just after the close of this rejection candle. On the formation of the next candle, you enter immediately. Don't forget we are still on what? Weekly time frame. This is weekly time frame. Okay, then you place your stop loss below it. Then you place your what? Your target here. 1:2 is more than enough. So now look at what eventually happened. Now look at it. After this rejection candle, there is what? The next candle that is formed must surely be an expansion candle. Can you see? Can you see this bullish expansion candle? So its price is raising towards what? Towards our target, because this candle has been what? This price has been rejected. There is no way that price will come down to take us out of the market. No way. It cannot what? Take us out of the market, because price has been rejected. So the intention of price now is to continue upward, is to continue pushing upward. So buyer will continue to what? To push price upward until it gets to another zone. Okay, another what? Zone for a reaction to happen. Now let's see how it eventually played out. Look at the next candle that was formed. It is also what? An expansion candle. And what happened? It hit our what? Our take profit. Can you see? So this would have taken you like 3 weeks. So just imagine the journey from here where you enter to this place is a whole lot of journey, because this is weekly time frame. It would have taken you like 3 weeks, okay, for you to what? To get to your take profit. And this is a lot of money, you understand? On this now you'd have made like $200,000, okay, for just waiting for what? Patiently for 3 weeks, okay, or probably 2 weeks. Okay, that is just that. Two candle rejection is easy. Now, after you are out of the market, price eventually reverse, and so that is why in this industry you don't have to be greedy. You understand? Just place your trade, then 1:2 is more than enough. If you have not taken 1:2, this is what would have happened. Price would have just, all the money, that all the $200,000 that you made would have what? Would have reduced, and eventually what? Take you out of the market. Okay, and you would have, you'd have gone into losses on that trade. Okay, but now luckily for you, you are out of the market already, because you are not greedy. Now let's take a look at this. Now we also have this on daily time frame. Look at it, this is daily time frame. Now this concept, which is two candle rejection, you can trade it on any time frame. Okay, now we are taking it on daily time frame. Now look at it, this is where the price is at the moment, right? Now we have what? A price leg that has a fair value gap. Now you wait for what? For price to come down into the fair value gap. If it gets rejected, if it's a rejection candle, then this is a huge opportunity for you to ride the market upward. Now let's take a look. If we have what? A rejection candle. First of all, you map out your what? Fair value gap. You see? Then you wait for what? For the next candle on that same time frame, because we are on what? Daily time frame. Now look at this candle. It has not entered into the fair value gap. You continue to wait. Okay, you wait for the next candle to what? To enter. The first candle that enter, that is what we should be what? Looking out for. Now eventually we have what? A candle that entered. This candle came in on a full body into this fair value gap. Okay, fair value gap magnetizes the what? The candle into itself. Then the moment the candle entered, fair value gap pushed it away. That is why we have this what? Long wick. Now, is it a rejection candle? Yes, it is a rejection candle, because I've taught you what? Some rejection candles. Okay, this is just like the one that we have here now, or probably it could be this, all right? That you see a rejection candle, because it has a long wick. The wick, so, is longer than its body, so it is a rejection candle. So now then you will now start looking out for what? For your entry pattern is so easy. What will you do? So you just wait. You understand? Once this candle is still breathing, you wait for the candle to stop breathing. Immediately the candle closed, you enter off of it immediately. Okay, you enter off of it. Then you place your what? You place your stop loss below it. When you place your stop loss below it, then you look out for a swing point. If there is a swing point, right, then you target the next swing point, or probably you trade towards the next swing point. You understand? Because now that it has been rejected, price has been rejected, what price will do is to chase liquidity. Okay, liquidity resides on swing high, swing lows. Okay, this is a PD array. This swing high is a PD array. It's a liquidity. There is money here. So price chase usually trades after money. When price has been rejected, what it does next is to what? Chase after money. Okay, now it will continue what? To chase after money. Now that is what it's going to do. Let's see what eventually happens. Or probably you could have targeted 1:2, which is not even up to this high. Okay, this is your 1:2 because you are not greedy. Because in this industry, you just have to what, take some profit and you move away. Okay, you run away. Okay, now let's take a look at this now. So this could have been our 1:2, right? Now let's see what price would have done or what price did. And you see, after this rejection candle, there is an expansion candle because rejection is an intention of price, that price wants to move. Okay, there's an expansion candle. Can you see? You would have been in what, huge profit because this is daily what time frame. Then let's see what eventually happened. Voila, can you see? It eventually got to our take profit. Eventually got to our take profit. Okay, so all on this move now, you'd have made a lot of what, dollars. Okay, you'd have made a lot of money. Now this, as small as this, don't forget this daily time frame. You'd have made a lot of money, maybe probably as big as your account size. It would have what, made you something like $100,000 or more, far more. You could even make millions. All right. Now that is that. Then now let's eventually see what happened when it got to this liquidity point. So price was now ranging. So that is why in my mentorship group, in my mentorship class, I've taught my students that when price gets to what, gets to a high, you have to wait to see what price will do, because when price peaks out liquidity here, we peaks out liquidity, all the money here, there is tendency that price will reverse, or probably what, price will continue upward. When price changes direction and reverse, that is what, sweep of liquidity. But if it continues to what, to move upward, that is what, liquidity run. They know all of this, so easy. Then now let's take a look at the next trade. Now, when you look at the next trade is on what, 4 hour time frame. As you can see, that is on 4 hour time frame. Now look at this. Do we have a fair value gap? Yes, we have a fair value gap here, right? Because this is where the price is currently at the moment. We have a fair value gap. If you have missed opportunity here, or probably you have been trading it up to this point, then you pause a bit, and now once there is a fair value gap that is formed, you wait to enter off of that fair value gap. All right, now let's see if there is going to be what, a retracement into the fair value gap, and the retracement, if it's going to yield a rejection. Now you map out your what, your fair value gap. Once you map out your fair value gap, now tell me, now this is what is going to happen. Price will definitely come into this fair value gap because we have what, a swing point. When you draw the swing point towards the fair value gap, you will discover that it's overlapping with the fair value gap. This overlapping line of defense, it is a strong zone. Okay, it magnetizes price towards itself, and when the price comes into it, it rejects price. So you have double what, confidence. Now fair value gap, which is supposed to do its work by rejecting price, then you now also have what, overlapping area, overlapping line of defense. Oh Lord. Okay, now let's take a look at it. You map out your wall. Can you see the oh Lord zone, overlapping line of defense zone in alignment with the fair value gap? So this is a huge opportunity. When you see this, so just jump on it and you ride it. Now let's see if it's going to produce rejection what, candle. Now can you see this is a rejection? Price came in a full body into this zone, but when it got into the zone, it got rejected. That is why it pushes price away. That is why we have this long wick. Now, is it a rejection candle? Yes. If you remember in my previous video, I taught you some examples of rejection candle. I brought them out here. Can you see? This one that we have here is similar to this, or maybe probably could be this or this. All right. So this is a rejection candle. Now, when you now notice that it is a rejection candle, how do you enter? You enter immediately as price closed. Okay, then you place your what, stop loss below it, and there is no way that price will have to reverse. Even though there is news release, it will not. It could only retrace a bit because this price has been rejected. So the intention of price is to what, move upward, is to continue to what, to buy with what, high buying pressure. That is why I will always preach it. You need to understand the language of the market. The market is a language and it is speaking to you. You should understand it. So when you understand some of these things, trust me, you will be profitable. You will understand what price will do next. Okay, can you see? Eventually, it went into our targets. Okay, If you had placed 1:2, you'd have made a lot of money from this move on this 4 hour time frame, right? So that is that about that. Now let's take a look at it again on 1 hour time frame. Now look at this on 1 hour time frame. Let me zoom it. So when I zoom it, do we have a price leg? Yes, a price leg is a leg that has what? Fair value gap. If you don't understand what fair value gap is, go and watch my previous video. It will explain to you what fair value gap is, right? Now that you have a fair value gap, then you wait for price to what? To push into the fair value gap. Don't forget, fair value gap acts as a magnet. It magnetizes price towards itself. Whenever a fair value gap is formed, okay, what price will do is that price will come back into the fair value gap to what? To respect it. So the moment price comes into the fair value gap, then after it enters into the fair value gap, then the fair value gap will now push it away so that there can be movement upward. And this is a bullish what? Fair value gap. If you want to know the bias of price, you should use fair value gap, because now when you wake up to what? To your London key zone, London zones, or probably your New York zones, you understand? So what you do is that you watch out for what? For fair value gap. When you see a bullish fair value gap, then you should know the intention of what? Of price. You should know that, okay, price is going to be what? Bullish. Okay, when you see a bearish fair value gap such as this, you should know that, okay, price is going to what? Is going to what? Going to be bearish. All right, that is just that about that. Then you map out your what? Your fair value gap. After you mapped it out, then you wait for the next candle to what? To come into the fair value gap, to be what? Attracted into the fair value gap. Now, do we have a candle? No. Look at it. This candle has not entered, so this is not it. You wait for what? A candle that enters. The candle that enters is what you should watch what? Closely. So now let's take a look at it. Now, do we have what? Another candle? No, this one went out of what? Out of it. So it didn't even tap into it. So now, as a trader, you would have thought that, okay, price is going to leave you fear of missing out. You'd have just jumped in. When you jump in, it is very dangerous, okay, because you have a fair value gap here. So fair value gap must magnetize price, okay. It is expected of price to, of fair value gap to what? Magnetize price, though it is not in all cases, because there are different types of fair value gap. These are the things that I've taught my students in my mentorship group, so they understand it. So you get it. So, but we can't be explaining all of that here. Now, what we are treating now is two candle rejection on a bullish price trend. So, how do we capitalize on all of that? So then you wait for that candle to enter. All right. So what will eventually happen is, can you see? We have a candle that enters on a full body. This candle came in on a full body. The moment it entered into this fair value gap, it got pushed away, it got rejected. So that is why we have what? A rejection what? Candle. Is this a rejection candle? Yes, just take a look at it. Take a look at it. Yeah, okay, it is actually a rejection candle. So how do you enter off of it? You wait for this rejection candle to close on that same time frame that you are in. So the moment it closes, you enter. Can you see this is the entry point? Then you place your stop loss below the low. So when you place your stop loss below the low, then you target the next swing what? The next swing point, or probably your 1:2. Don't forget, your 1:2 is more than enough, okay, to make you super rich. So when you target your 1:2, and that is all, you just look at it. Then this is what happened. After you've placed your trade, there is this candle that came down, and you would have thought, okay, oh, this price has reversed, it's going to take me out of the market. It is fine, you understand, but there's something that is called what? Trading psychology. You need to what? You need to have it balanced, okay. You need to have a strong trading what? Emotion. Now this is it. When you set your trade, when you enter a trade, you place your stop loss. Now the money that you are risking is no longer your money, so take your mind off it. So set your trade and forget about it. That is how to what? Put your psychology on check, okay. Now you place your trade and forget about it. This is not your money anymore, all right. it is not your money. Even though if it is $50,000 you are risking, it is no longer your. Take your mind off it that this is not my money. So whatever happens to it, fine. Now another thing is that you have to what? You have to respect your trading strategy. You have to respect it. You have to have confidence in your trading strategy, your trading plans. Okay. If you don't, trust me, the markets will mess you up. All right. So after you've placed this trade and you place your stop loss here, this has been rejected. Okay. We don't expect price to come down to what? To take out this low again. We don't expect price because it has been rejected. So when price has been rejected, what price should do next is to expand upward. Okay. Now this, what happened here could be news. Yes, news came down and there's no way it will take you out because it has been rejected. Price has been rejected. So price is expected to what? To move upwards, all right, to your target. So let's look at what eventually happened. Can you see? After this candle close, after the news release, what happened? Price went in its direction. Okay, it went in an expansion what? With an expansion move towards your what? Towards your profit, and you were able to profit from what? From this trade. This huge what amount of profit. And that is that about that. Now the next video is going to still be on two candles rejection, maybe on a bearish what? On a bearish market. All right, if you've not subscribed to this YouTube channel, you have to do that. Press the notification button because there are so many other videos that will be released in return. So these things are very easy. Forex trading is easy. So just understand the what? The language of the market. Okay, the market is telling you a story, so it is now left for you to understand it. So these are the what? These are the things that I'm actually simplifying to you. So the moment you understand this, trust me, you'll be profitable in the long run. The moment you understand it, you will be able to pass your profits. You make a lot of what? A lot of money in the market. All right, thank you, Ages.